Hello, I'm Hans Lee from Livewire Markets, and welcome to another interview in our Undiscovered Funds series. Now, in the survey that we ran alongside this series, a lot of you, readers and viewers, said that you would only invest in a nascent fund if you knew the fund manager and they had a long track record. So with that in mind, today's guest perfectly fits that bill. Christopher Joy is the co-founder and CIO of Coolabah Capital. Recently, Coolabah opened up its active composite bond strategy to retail investors and launched another fund as well besides. Chris is now joining us to discuss that and the lay of the land in Australian fixed income. Good to see you, sir. Thanks for making the time.
Thank you, Hans.
So let's talk about the active composite bond strategy first if we can. So I understand it was launched in 2017 for institutional investors, but it's only just been made available to retail investors. Why did you take the extra steps to do so?
Yeah, so we were approached by a super fund in 2016. They did a global search for a long duration or fixed rate bond manager. We were actually a short duration manager, a credit trader, so to speak, and we didn't offer any long duration strategies, but we were invited into the search. It was undertaken by a research firm called B Finance, and we actually won the search and created the active composite bond strategy for this super fund, and we launched it in March 2017. We think that today there's unusually high demand and interest in fixed rate bonds. Back in 2021, we were very negative fixed rate bonds because we thought yields would skyrocket and this would reduce the value of fixed rate bonds. And indeed, in the 12 months to June 22, fixed rate bonds had their worst 12 months in history. In the US, the market had its worst year in 100 years. And that was, again, a function of the rise in interest rates. But fixed rate bonds today appear very attractive because yields have increased. We've seen the RBA cash rate rise from 0.1% to almost 4%. And similarly, the 10-year Aussie government bond yield has risen from around 1% to, again, almost 4%. So we think that investors are looking to diversify away from riskier asset classes with lots of risk of capital loss, like equities, venture capital, high yield bonds and private debt. And they're looking for more liquid solutions. The active composite bond strategy has an average credit rating of A to AA. It offers daily liquidity, and it's likely to perform particularly well in a recessionary environment where rates start declining and the value of fixed rate bonds appreciate. Most managers have historically underperformed the benchmark, the composite bond index, because they tend to bet on the direction of interest rates, what the RBA, the Fed, the Bank of England and the ECB and so forth are going to do. With the active composite bond strategy, we don't do that. We keep the duration fixed. We're not betting on the direction of rates, but we add value through our very active credit trading style.
Okay. So I mentioned there at the beginning there was actually another launch in December of last year. Can you differentiate between the two funds and maybe tell us a little bit about why you actually launched that second strategy?
Yeah, so it was actually a similar situation with the active composite bond strategy. The super fund invited us into that search process and said, we think you can run a long duration strategy using your active credit style. With the new Coolabah floating rate high yield fund, which as you said was the second fund that we have launched into the market in December last year, we had clients come to us and basically say, the interest rates we're getting right now on the major bank senior bonds and their tier 2 bonds are supremely attractive. We can access rates on senior bonds of about 5% and on tier 2 bonds of about 6.5%. In 2021, those rates were, in the case of senior bonds, only 0.25% per annum. And with tier 2 bonds, they were paying about 1.25% per annum. So we've seen this massive increase in interest rates. The yields on other asset classes like commercial real estate, paying 4 or 5%, resi property, 4%. Bank equities, CBA shares, even if you take into account franking credits, they're paying grossed up for franking about 6%. You're getting better interest rates on CBA bonds than CBA shares. So with the Coolabah floating rate high yield fund, we would argue the bonds themselves, Aussie major bank senior bonds and tier 2 bonds have very, very low default risk. Even if you look at Credit Suisse, recently blew up. The hybrids were wiped out. The equity was hammered. The tier 2 bonds were actually protected fully. The senior bonds of Credit Suisse were protected and the deposits were protected. So in the Coolabah floating rate high yield fund, we just have senior bonds and tier 2 bonds issued by 80% of the portfolios, the major banks and some regional banks. And you're using gearing and very low cost gearing to enhance the yield to around 8% net of fees. And we think that's a really interesting diversifying solution for those who are still looking for high yields of 8 to 9% per annum, but are worried about the default cycle and they're worried about illiquidity.
The Credit Suisse and the AT1 situation was so interesting and made so many headlines around the world. Let me step back, if I can, with something a little more general. And I feel like if there's anybody who should know the answer to this question, it's you. Why should everyday investors consider fixed income in today's environment?
Well, I think it's really about the rise of yield. If you look across the capital stack and the asset class universes, as we've discussed, A-grade office property today is paying 4.5%. You can get better returns on cash deposits. TDs are paying up to 5%. So that doesn't make sense. So unlisted commercial property has a big problem, which is its yields have not adjusted to the fact that cash is paying 5%. Government bonds, risk-free government bonds, are paying 4 to 5, particularly if you go into the state government bond market. The major bank senior bonds are paying 5%. Their tier 2 bonds are paying 6 to 7%. And everything else needs to compete with those very liquid and very safe hurdle rates. So we've had clients say to us, Chris, for us to consider investing in anything outside of that, safe cash, government bond, and bank bond universe, we'd need a risk premium of 3 to 5%. But equities, Aussie stocks are paying probably about 4.5% on a cash basis. With franking, the share market is paying about 6%. So again, inferior to bank bonds. If you look at bank hybrids, they're paying 7.1%. If we look at resi property, I mentioned this earlier, but gross, you're getting about 4% in Sydney and Melbourne on investment properties. But after the manifold transaction costs, you're probably earning 2 to 3%. So we see a lot of discontinuity between the yields in our liquid asset classes, like private debt, high yield, resi property, commercial real estate, venture capital, and private equity and infrastructure, and the yields in liquid high-grade bonds. So, my own view is that if you had a blank sheet of paper right now and you wanted to build a portfolio, personally, and obviously this is not financial advice, but personally I'd be long cash, long high-grade government bonds, fixed rate, long high-grade floating rate bank bonds, and that provides you with a very attractive yield. It provides you with tremendous liquidity, and it also affords a great deal of optionality, because at some point, Hans, the dust is going to settle. Stocks are not pricing in what is a very high likelihood of a US recession, and they're also not pricing in structurally high discount rates. In the bond market, we're seeing right now expectations for substantial rate cuts from the Fed. And I think the equity market is looking at, recently it's been 80 to 100 basis points of cuts for the Fed in the next 6 to 12 months. And I think the equity market's been taking comfort from that, because I think the equity junkies have been saying, hey, the bond market's telling us the Fed's going to cut by 80 to 100 bips. We'll have a recession. We can look through that. We're pricing 10-year cash flows. But in truth, I think what the bond market is doing is very different. The bond market is probably pricing 2 scenarios. The first is GFC Mark II, total unadulterated cataclysm. And in that cataclysm, the Fed goes to zero. So there's a small probability on the Fed going to zero. And then the second contingency the bond market's pricing is probably the model or central case, which is the Fed staying at a very high rate and possibly going higher over the next couple of years. But when you average those 2 scenarios, you end up with 80 basis points of cuts. But I don't think we should take sucker from that expectation.
What is the most interesting debate you're having in your investment committee right now?
I think the kind of big thematic that is interesting to think about is a combination of the advent of potentially the biggest default cycle in Australia since 1991. We're seeing right now that global corporate defaults today are the highest since 2009. US insolvencies are the highest since 2010. At the nadir of the pandemic, Australia was seeing 200 to 300 businesses a month go bust. Now we're running at 700 to 800 businesses a month. We model very carefully the delinquency rates reported on home loans originated by bank and non-bank lenders. And we're seeing a very, very big increase in non-bank delinquencies. I think we're going to see a fundamental, we believe, rewiring of the neurology of the global economy. For 30 years, we had ever cheapening money. For 30 years, we've had a reach for risk and a search for yield. And this has created entire industries. I think private credit didn't exist in Australia prior to the GFC, but people wanted higher interest rates. The banking regulator went to the banks and said, listen, you've got to stop lending to these riskier, dodgier borrowers. Those borrowers still needed loans. And we've obviously had a class of intermediaries rise and provide them with finance. But we do think that structurally higher interest rates, which are the new normal, will wipe out many of these zombie companies that have emerged, particularly since the GFC. On our modelling, when we look at listed firms globally, and we define zombies as companies that don't have enough profitability currently to pay the interest on their debt, forget the interest in principal, just the interest on their debt. We've documented prior to this rate hiking cycle an increase from around 5% of all firms to around 15% of all firms that are classified as zombies in the US, Europe, Australia, and the UK. And they all tend to be found, these zombie companies, in the same industry sectors. One of the top sectors is real estate, followed by technology, communications, healthcare, and energy and resources. So we think the zombies are going to be wiped out.
Do you think that is the one major theme that, not just fixed income investors, do you think that is actually one major thing that investors are missing or maybe underpricing right now?
Yeah, I actually do, Hans. I think there's a bit of cognitive dissonance. I think there's a lot of hopium. I think it's partly a function of the fact that, and no disrespect to my beloved millennial acolytes, but the truth is, like, the average age of folks working in markets is probably sub 40. Most of these folks have not lived through a period of high inflation. They haven't seen a period of sharply, sorry, when I say lived through, worked through a period of high inflation. They haven't worked through a period of sharply increasing interest rates. They haven't seen, in Australia at least, a massive increase in unemployment. And the buy the dip reflex that is kind of institutionally ingrained into the DNA of anyone who entered the labour force after 2008, where the policymaking reaction function was always cut rates to zero, print money endlessly. The central banks would buy all sorts of assets, bonds and equities, to bid up the value of those assets to create those positive wealth effects. But that toolkit is no longer available because we have the binding constraint of high inflation. One of the reasons we set up Coolabah in 2011 as a floating rate specialist was precisely because our view was that this cycle of never-ending zero interest rate policies and QE to infinity would ultimately give us an inflation shock, because that's kind of the final solution. What I think this behooves is a lot of intellectual humility in terms of what we face going forward and the structure of our portfolios. Our portfolio structures are likely going to have to change quite dramatically. And in our view, it's unlikely equities and other highly interest rate elastic sectors like high yield or private debt are going to be the best sources of risk-adjusted return for many years to come.
Chris, I take it then with what you were saying around, having flexibility with duration, having flexibility around quality, right? The quality of the investments that you're in. Does that reflect heavily then in the current composition of the two funds that we've been talking about?
Yeah, so currently, we move our portfolios a lot. So in the active composite bond strategy, our annual turnover ratio can be as high as 7 times. Now, we typically don't have any transaction costs because in the bond market, you don't pay commissions, you only pay bid offer spread, but we generally don't cross the spread, we normally earn the spread. So these are very, very active strategies, but we're not actively managing the interest rate exposures. We're not betting on interest rate markets. We're not trying to second guess the RBA, Fed, BOE or ECB. What we are trying to do is actively select the individual assets. What government bonds do we want? What bank bonds do we want? What corporate bonds do we want? And particularly we're focused on assets that are paying unusually high levels of interest for their risk. So in a perfect world for us, what we'll do is we'll see a new issue come along and let's say in theory, fair value for that particular bond is an interest rate of 5%, but instead the issuer pays us 5.5%. So we buy it at 5.5%. The interest rate over time normalizes or mean reverts to our fair value target of 5%, and we get a capital gain, and then we move on. Currently in the portfolio, we have exposures to Commonwealth government bonds that are cheap, but we hedge out the interest rate risks if we're not running any duration. We have some very, very modest exposures to state government bonds that in certain sectors appear cheap. We have substantial exposures to senior ranking bonds issued by the major banks and some of the more highly rated regional banks. And we also like tier 2 bonds issued by the major banks, as we've mentioned. Most of those securities, if not all of them, are trading on spreads that are very historically elevated. So if we look at semis, normally 10-year state government bonds are paying you about 35 basis points over Commonwealth bonds. Currently, they're paying about 70 basis points over Commonwealth bonds. If we look at senior ranking major bank bonds, normally they're paying you about 70 to 80 basis points or 0.7 to 0.8% above bank bills. Currently, they're paying about 100 basis points over bank bills. And then finally, in tier 2, typically tier 2 pays you 170 to 180 basis points over bank bills. Presently, you're getting 230 to 240 over bank bills. In these two strategies, the Coolabah Active Composite Bond Strategy and the Coolabah Floating Rate High Yield Fund, as I mentioned, one's paying 6.1% in terms of the cash yield, the other 8% net of fees. In these strategies, we don't have any hybrids. We do run hybrid strategies, and the all-in yield on hybrids is actually very attractive at 7.1%, but we don't have hybrids in these portfolios.
Okay, sounds good. So with that said then, well, obviously we were talking about one major theme that maybe investors are underpricing right now. So let me re-ask that question, but maybe it's in a slightly more actionable way. Where do you think the next mispricing will be, and how do you intend to take advantage of that?
Probably the single greatest opportunity that we're looking at right now is what we call the primary market or the new issue market. So again, we're looking for mispriced bonds that are paying too much interest for their risk-adjusted factors, and we use linear and nonlinear models to quantify that. That are all, again, proprietary to Coolabah. But in the new issue market, we're seeing tremendous opportunities. Issuers realize that in order to raise billions of dollars per issue, they're having to pay over the odds. And we're getting unusually attractive new issue concessions, which basically means we're earning a lot of interest above and beyond what would otherwise be required. So that's one sector we're focused on. So in the bank senior market in euros, in US dollars, and in Aussie dollars, we're focused in that market. Last night, we, for example, bought a Canadian bank senior bond in US dollars that was cheap and had an attractive new issue concession. But I think it's really, really important to stay in the high grade sector. So we're talking about issuers that are typically A rated or higher, issuers that are incredibly liquid. Ideally, we focus on government guaranteed issuers or implicitly government guaranteed issuers. Rarely do we deal with corporates, it's mainly governments and banks. But when we do deal with the corporates, it's companies like a Woolworths, an Optus, a Pfizer, a Verizon, something that is an oligopolist and ideally implicitly government guaranteed as a kind of national champion of sorts.
Yeah, no, absolutely. And as you say, being in banks, Woolworths, Optus, those kinds of businesses, part of that, not too big to fail, but certainly they're part of that very high quality, very well known, likely to not default club. I think that's what you're getting at.
Yeah, and I think this is a very, very important point because normally in fixed income, that's not the paradigm. Typically, the paradigm is if you want more yield, you don't trade more actively. You don't have 40 people revaluing all bonds globally real time. What you do is you just reach for risk. So if you want more yield in fixed income, normally you're just taking more default risk or more liquidity risk or more interest rate duration risk. And that's the easy thing to do. You can pull together a portfolio of 500 to 1,000 bonds. And if you want more return, just dial up the risk and happy days. Of course, the problem with that is you end up diversifying into stuff that perhaps you didn't want to hold. So classic traps for Aussie investors recently have been Virgin Senior Bonds. Everyone bought the Virgin Senior Bonds, paying high 7% interest. Everyone thought that was safe as houses. We didn't touch it with a 40-foot cattle prod, and of course it was wiped out. In fact, we were trying to short Virgin Senior Bonds in March 2020. Another example is the Credit Suisse hybrids. Surprisingly popular, the Credit Suisse hybrids amongst Aussie investors, in both retail and institutional portfolios. And we don't invest in European bank hybrids simply because we trust Aussie banks and we trust certain global banks. But the one thing we never do is go right down the capital structure.
So just quickly to finish on distributions, obviously it's one of the great joys, one of the great advantages of investing in fixed income. So what sort of distributions are your funds offering and how can investors access it?
Yeah, sure. Coolabah's active composite bond strategy currently pays a cash running yield of 6.1% per annum. It's available on the exchange via Chi-X. It's also available through advisors via platforms. And you can actually invest in it in an unlisted sense through a platform or via the exchange. So it's actually something called a quotable fund that is both an ETF and an unlisted fund. The distributions are quarterly and they're paid out automatically. The Coolabah Floating Rate High Yield Fund also distributes quarterly. As I mentioned, net of retail fees, It's paying out about 8% per annum right now. Pre-fees is paying out about 8.9%, and that is also available via platforms, currently only in an unlisted format.
There you are. Chris, it's been a pleasure to meet you. Thank you very much for joining Livewire's Undiscovered series.
Thank you, Hans.
And thank you for joining us. We hope you've enjoyed the whole series. If you've missed any of it, you can go to livewiremarkets.com.